Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, September 14th, 5:49 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Excuse me. So, tough market over the last couple days really started with the indexes gapping and closing near the lows late last week. And any strength is being sold right now in the indexes, but leaders are holding up better than the overall indexes. That's what we're going to do some diving into in this video. So state of the market, we're in a short-term pullback. You can see over here by the trend gauge. Still showing bullish on leaders, but with a yellow arrow pointing towards neutral as some have broken the 21-day moving averages. That's really how we gauge leadership. So as far as the short-term trend goes, using the 5 major indexes, and why do we always talk about the indexes? Because 75% of stocks will follow the overall trend of the market. And short-term, only the NASDAQ 100 is above the 21-day short-term exponential moving average, and it's really holding on by its fingernails to that. In fact, we put a hedge on today when it broke recent lows and the 21. It had a little bit of a rally into the close to close just about right on the 21. So we're showing neutral short-term. So medium-term, we've got 3 indexes, actually 2 indexes above the 50-day, 3 below the 50-day now. So still showing bullish, but again, the arrow pointing towards neutral. We'll take a look at all of this momentarily, including how the long-term trend continues to remain up. So what happened today? Indexes weak, leaders mixed. So you can see right here the G5. This is a composite that is made up of 5 growth indexes, and it's the average of the 5. 4 of the 5 were negative today. The FFTY, the IBD 50 index, was positive. The weakest was IWO, actually just about in tied for the week. The weak leadership was ARKK and IWO, down over 1.5%. Excuse me. So leaders can act 1.5 to 2 times to the upside and to the downside, sometimes more than the market's doing. So if you see a weak day in the indexes in the G5 down, or for the most part outperforming most of the indexes, you can have some confidence in what's going on, provided you refer to the charts of the leading stocks that you're holding, and they're for the most part holding the 21-day moving average, and ours are. So as the indexes deteriorated today, we had a little bit of a mixed bag, but for the most part there was, let's put it this way, if we would have sold something today, it would have been out of emotion, not out of the fact that a stop got hit. Yesterday was a different story. Yesterday, leaders were hit extremely hard. We underperformed in-house. That was really the first day through September that leaders have been substantially weaker than the indexes. Going back to the 1st of September, we had days where we outperformed by 29 basis points, 51 basis points, 77 basis points, 8 basis points. Down, lagged by 18, outperformed by 64, underperformed by 9, and then yesterday underperformed by 139, outperformed today by 24. So one big bad day in there, but everything that the stops got taken out of yesterday in-house, everything that we sold, the stocks are higher now. So that shows the strength in the leaders, or how they continue to be resilient, and we don't want to just out of emotion throw the baby out with the bathwater. Now, that doesn't mean that we haven't cut our exposure. We came into the week with an adjusted beta of 2, took 20% of that off yesterday, and another 20% of that off today with the hedge that we put on. So we've gone from 2 to 1.6 in 2 days, and that's reflective of what's going on with the indexes. Mixed weakness in leadership, as I talked about some things that we've gotten stopped out of, but that we're still holding partial or half positions on. But for the most part, we're giving the market the benefit of the doubt based on what's going on with leaders. But as always, our stops are in place, and if they get taken out, we will go with them. We've got about 4% to the downside, 3.5 to 4% to the downside before all of our stops would get taken out, or we would be fully hedged. So enough talking. Let's get to some charts here. First, let's take a look at the brain trust here at Revere. If you're interested in an approach that will get you out of the way with a plan when the markets start to turn south, we're the registered investment advisor for you. Give us a shout. You can either call 855 Real Wealth. That's 855-732-5932, or you can email any of us. Dan's a CFA, one of the most knowledgeable financial people I've ever met. Proud to be a partner of his. He can be reached at dan@revereasset.com, also an expert at annuities and estate planning. Tim's our short-term strategist and an expert at inter-asset correlation. Muriel's our office manager and heads up the onboarding effort for new clients. Hunter and Alex, our junior portfolio managers and research analysts, constantly feeding me ideas. We have calls 3-4 times a day going over the leadership, what's lagging, looking for low risk opportunities, and then we pull the trigger on what's going on with the portfolios. We've got strict rules as far as what our approach should be, what our exposure should be based on what's going on with leading stocks and indexes. And if you like this idea better than just blindly losing 34% of your portfolio in 5.5 weeks like happened with COVID last year, maybe give us a shout. Feel free to reach out to us. We'd love to talk to you. So let's start off with the S&P 500 here. And now you can see we've got 3 closes below the 21-day exponential moving average, and it has rolled over. The 21 has rolled over. We're coming up on the 50-day moving average. So the question is this a visit to the 50-day moving average that's more like January, where we really didn't see growth stocks get hit anywhere near as bad as the index did? Or is this going to be more like February, where growth stocks were down 3 to 4 times as bad as the S&P 500 did? Based on what's going on right now, it's closer to January. But if evidence to the contrary comes in, like I mentioned, we've got our stops in place. They'll get taken out, and our downside is about 4% right now. So there's your NASDAQ 100, very clear. Break of the 21, 3 closes below it now. And less than 1% above actually 0.3% above the 50-day moving average. NASDAQ 100. Let's look at this. You can see it's looking like it closed below, but it's actually right on the 21-day exponential moving average. Let me shrink this down and bring up a 60-minute chart on this. And we were watching yesterday's levels very closely. The breakout here is around this 369, 370 area. We pulled back and tested it and didn't really even come close to it toward the end of August. Made new highs early in September, and now we're testing this subsequent breakout here around this 375 area here. So the lows of the last couple of days, if they hold, that corresponds with the 21-day moving average, and that would be very natural and also would correspond to really what's going on with the leadership stocks holding up okay. However, you can see some higher volume here over the last 3 days on the sell-off. And going to the 60-minute chart, we do have room to fall down to this 370 area. So when we pierced below yesterday's low, that's when we put the hedge on. Let me go a little closer to a 1-minute chart with this, and it was really when we broke down in this area right in here that we put it on. Take a look at what has happened using this 15-minute chart over the last 4 days. We've got a gap up, sell off. That's last Wednesday. Last Thursday, gap up, sell off. Last Friday, gap up, sell off. And then today on week CPI, which was initially, it gave a reason for the indexes to gap up, but again, sell off. So what we're doing both on the S&P and the NASDAQ 100, is over the last 4 days making lower highs and lower lows, and that's the definition of a downtrend, and that's why we've got we're at neutral on the short-term time frame. So you can see the S&P broke below yesterday's lows more convincingly than the NASDAQ 100 did. And when we see this, we take action in the portfolios because it's mildly out of character for what should be happening in a bullish market. We want to see the market trending higher above the 21-day moving average. It breaks the 21. We want it to hold the 50. Well, now we're coming into the 50. This break of the 21 causes it to take some of our exposure off, and then how the leaders continue to react and how the indexes continue to act will dictate our next move. We're not predicting we could hold here. I mean, things have looked bad several times this year with breaks of the 50-day moving average. The issue is none of them has lasted more than a week or a week and a half before you get right back above it. So as always, we'll continue to look for low risk entry points and stick into the leaders as long as they continue to act well. Let's go to the Dow Jones Industrial Average. This has not been acting well. You did see a little tick up Friday and Monday in relative strength, but not today, and it made a lower low and has now clearly broken below the 50-day moving average. So we've got the NASDAQ 100 and the S&P holding the 50. The Dow has broken below the 21-day. Let me zoom this in a little bit. The 21-day, the green line is clearly rolled over and is going to break through the 50-day moving average over the next couple of days. So there's your Dow Jones Industrial Average. Now we'll go to mid caps using the MDY sector ETF. You can see a break below the 50-day moving average. Close below it Friday, back above it Monday, another close below it on Tuesday. Couldn't get back above the 21 over the last couple of days on any rally attempts. So again, showing more weakness here. So that's another index below the 50-day moving average, and IWM also breaking the 50-day moving average today. This has been extremely choppy, and it's coming into the 200-day moving average. So that'd be another test of the 200-day moving average on small caps is on tap. So let's talk about some individual stocks and how they're holding up versus the indexes. But first, let's take a look at the 5 components of the G5, and let's do a little bit of a deeper dive on these. And let me, in fact, blow these up here. So IWO, this is the growth component of the Russell 2000. Set aside the moving averages for a second, okay? Look at this big run that they had from 819 to 902. Moves in stocks and in indexes are entitled to give back half of it before the trend that was established by that move is broken. And that's about where we are on these, although we have indeed broken the moving averages. But from a pure Fibonacci standpoint, of a 50% retracement, we haven't hit that yet on IWO. Let's go to the next one. That's a component of the G5, the FFTY. Okay, same situation here. Pretty big move up here, harsh pullback Monday, bounce today. This thing was up. This is the most active. Well, 2 of the indexes are active, and IBD gets rid of laggards and puts in leaders constantly. So it's not surprising when you see an update with this when the other components of the G5 are lagging. But again, this hasn't really retraced. It maybe did on a cut below here, but closed back above the 21, 50% of the move. So again, give that the benefit of the doubt as far as it not giving up that recent move. The third component is QQQJ. Same situation. We went from 32.65 up to 35.36, and we've pulled back to 34. About a 50% retracement, holding the 50-day moving average. Number 4, ARKK. This is the laggard in the group. Has given up more than half of it. In fact, it's just a few percentage points away. Maybe it's about 3% away from testing the lows of that. ARKK has been lagging all year since its big move up. Early the first 5 weeks of 2021 that continued its outperformance from 2020, but really hasn't been able to get back moving ever since then. And one of the reasons is this is weighted with a couple of stocks, extremely high weights. in ARKK. And if they're not acting well, then the ARKK isn't going to act well. And finally, PDP, a momentum ETF, that's given back it bounced to get a little bit more than 50% below the retracement, but it's right about on the 50% level here. So what I'm trying to get at is it's time to fish or cut bait for these indexes, the leader indexes, and how they correspond and react to this 50% retracement is pretty much going to dictate what's going on with the leading stocks that we own in-house, which I'm going to quickly run through so that we can see where we stand, and I can show why we really didn't have to sell anything yesterday after taking some things off today. First of all, the position that we closed yesterday, ETHE, below the 21, closed below, has been lagging lately. Got back above the 21 today. Not interested in this right now. Sticking with growth names that are working. I'm not going to mess with cryptocurrencies for the time being. So DraftKings, we got stopped out of half of this yesterday. Chart looks fine. We bought in here when it had a tough move, but this was already a sharp move off of the low, so maybe a lower risk entry point could have been had. Was acting well, harsh pullback the last 3 days. This is actually showing a handle now in a big cup and handle, and it's sitting right on the 21. When it broke the 60 level, we got rid of half of the position, but are still holding a half position, just a couple of percent in the negative on this one. Another one we stopped out half of was net with this harsh move below the 21, but by the end of the day, it reclaimed the 21 and had a very positive day today. And this is what we're seeing. I mentioned there was 1, 2, 3, 4, 5 things that we sold yesterday, actually 4 things that we trimmed, and where we sold, the prices are still above where we sold. So that's some feedback from the market saying that leaders are holding up. Okay, they're not falling apart. They bounced from the initial selling on Monday. Datadog, another situation with this. We bought this several times, but when it broke to 21 and was showing weakness, we got rid of half of the position. Strong day today, still holding half of our position in Datadog. Dexcom, sold a quarter of the position yesterday on this break below the 8 because the 8 was really containing this move up. When the 8 rolled over and it broke, it was a little bit of a change in character. You can see it had a nice move up earlier today, but closed near the lows, albeit still positive, sitting right on the 8. And we're holding that other half when it's holding, as long as it holds the 21. So other things that we continue to hold that are acting okay. NVIDIA. This is fine. Lower volume pullback above the 21. Nothing wrong with that. Upstart, UPST, volatile, and we have smaller positions on these, but it's holding the ADMA, and that's just fine with me. Let's take a look at Apple, which had this has been one of the reasons why the indexes have been impacted, is because Apple had a negative court ruling on Friday, and then they had their Apple Day today, unveiling the new iPhones, and the market was not overly impressed by it, but it broke the 50-day moving average and closed back above it. Today's low is a very key level for this, and that also is going to correspond to what's going on with the indexes because of the big weight that Apple has in the NASDAQ 100 and the S&P 500. So this is probably the weakest of our holdings. And we hold between a 3 and 5% position depending on what portfolio you're in. So some more leading stocks that we own that are still holding up above their moving averages. Affirm, this big gap up on Monday, lighter volume pullback, holding this 100 breakout area. Snow, SNOW, acting fine, bounced off the 21 yesterday. And hanging out near the highs. You'll notice that these charts that I'm going through, the charts look better than the charts of the QQQ and the S&P 500, and that quite simply is because leaders, as I've mentioned several times, continue to outperform the indexes. Lululemon, gap up, holding around the lows of this gap. Usually I give about 2% below the low of a gap day. This may come down to visit the ADMA, but if it continues to go sideways, this looks really good, and that was really big volume, 710% on Lulu, and a 10.5% gap up on its earnings report. How about letter U? Lighter volume pullback, well, average volume pullback to the 21, bounced above it again. After this nice move up on its earnings report, higher highs, higher lows. That's a definition of an uptrend. Let's see, Ambarella, one of our three biggest positions, and just acting very well. Massive volume, 1,270%. You don't see this very often on a gap up move on earnings. Didn't quite get out of the base, but it really, you could argue that it did, except for this one big reversal on its last earnings report. Different story on this earnings report. Broke back above it and is continuing higher. Hasn't come back to touch the ADMA yet. Very strong acting stocks, and in fact, semiconductors have been outperforming. They're near their all-time highs. They're a pretty big part of the NASDAQ 100. So semis are very clearly outperforming the FANG type stocks right now, after lagging for a little bit while FANG was carrying the torch. And in particularly, I'm talking about this period of time in here. At the beginning of August, when semiconductors lagged, you can see the relative strength lagging there. They made a bounce, went sideways, and now they're re-exerting their relative strength. So it seems like money is flowing into semiconductors, and that should help to prop up the QQQ, and also a reason why the QQQ is still the only one of the 5 indexes above its 21-day exponential moving average. Let's wrap up the rest of what we're holding here. DOX continues higher highs, higher lows. DraftKings, I talked about how we got rid of half of that. Another, for some diversification, we own Devon. Oil stocks have been really a mixed bag lately, but Devon is a leader. Datadog, I talked about that. Tesla has shown some relative strength over the last couple of days, and really over the last 3 weeks compared to the indexes, undercutting but reclaiming and closing at the top of the range on Monday, and up slightly today. That looks good, and that is everything that we own in-house. So what you're seeing for the most part is relative strength continuing to work on these leading stocks that we're holding. We set stops on them relative to the 8, the 21, or the 50 EMA, depending on where our entry was and how long we've been in them, and try to take the emotion out of it by letting the stops take us out. And like I said, if we'd have sold some positions today, it would have been on emotion and not because our levels got broke. But to combat that weakness in the indexes, we did add a hedge, a 10% SQQQ hedge to the portfolio, which brought our beta down to about 1.2. We'll see where this goes relative to the 21 and see how the leaders continue to react, and we'll make our decisions accordingly. So as always, I'd like to hear feedback from you. I'm on Twitter at Vandenbord, email don@revereasset.com, phone 855-REAL-WEALTH. Wrapping up Tuesday, November 14th. It's Don Vandenbord, telling it like it is. Thanks for listening and have a great day.